Part 4. The Gold Exchange Standard in the Interwar Years. Great Britain emerged victorious from its travail in World War I, but its economy, and particularly its currency, lay in shambles. All the warring countries had financed their massive 4-year war effort by monetizing their deficits, most of them doubling, tripling, or quadrupling their money supply, with equivalent impacts upon their prices. The massive influx of government paper money forced these warring governments to go rapidly off the gold standard. The currencies depreciated in terms of gold, but the depreciation was masked by a network of exchange controls that marked the collectivized economies during World War I. Only the United States, which entered the war 2.5 years after the other countries and hence inflated its currency less, managed to remain de jure on its pre-war gold standard. De facto, however, the U.S. barred export of gold during the war, and so was effectively off gold during that period. In March 1919, when foreign exchange markets became free once more, the bad news became evident. While the dollar, again de facto as well as de jure on gold, remained at its pre-war par, approximately 1/20th of a gold ounce, European fiat paper currencies were sadly depreciated. The once mighty pound sterling, traditionally at approximately $4.86, now sold at approximately $3.50, and at one point, in February 1920, was down to $3.20. Here was a 30 to 35% depreciation from its pre-war par. Thus, wartime and post-war Europe was thrown into a cauldron of inflation, depreciation, exchange rate volatility, and the menace of warring currency blocs. For the first time since the Napoleonic Wars, the world lacked an international money, a medium of exchange that could be used throughout the world, and lacked the international harmony, the monetary stability and calculability that a world money could generate. Europe, and the world, were plunged into the chaos of an international, moneyless, or barter system. All the countries therefore looked back with understandable nostalgia at the relative Eden that had existed before the Great War. The classical gold standard. The 19th century monetary system has been referred to as the, quote, classical gold standard. It has become fashionable among economists to denigrate that system as only existent in the last decades of the 19th century, and as simply a form of pound sterling standard, since London was the great financial center during this period. This disparagement of gold, however, is faulty and misleading. It is true that London was the major financial center in that period, but the world was scarcely on a pound standard. Active competition from other financial centers, Berlin, Paris, Amsterdam, Brussels, New York, ensured that gold was truly the only standard money throughout the world. Furthermore, to stress only the few decades before 1914 as the age of the gold standard ignores the fact that gold and silver have been the world's two monetary metals from time immemorial. Countries shifted to and from freely fluctuating parallel gold and silver standards in attempts, self-defeating in the long run, to fix the rate of exchange between the two metals. Quote, bimetallism. The fact that countries stampeded from silver and toward gold monometallism in the late 19th century should not obscure the fact that gold and silver, for centuries, were the world's monies, and that previous paper money experiments, the longest during the Napoleonic Wars, were considered to be both ephemeral and disastrously inflationary. Specie standards, whether gold or silver, have been virtually coextensive with the history of civilization. Apart from a few calamitous experiments, such as John Law's Mississippi Bubble and the South Sea Bubble in the 1710s, and apart from the generation-long experience in Britain during the Napoleonic War, until the 20th century, specie, rather than paper, had always been the standard money. In the classical gold standard, every nation's currency was defined as a unit of weight of gold, and therefore the paper currency was redeemable by its issuer, the government or its central bank, in the defined weight of gold coin, while gold bullion, in the form of large bars, was used for international payments. Gold coin was used in everyday transactions by the general public. For obvious reasons, it is the inherent tendency of every money issuer to create as much money as it can get away with. But governments or central banks were, on the gold standard, restricted in their issue of paper or bank deposits by the iron necessity of immediate redemption in gold, and particularly in gold coin on demand. As in the familiar Hume-Cantillon international price specie flow mechanism, an increase of banknotes or deposits in a country beyond its gold stock increases the supply of money, say francs in France. The increase of the supply of francs and incomes in francs leads to A, an increase in both domestic and foreign spending, hence raising imports, and B, a rise in domestic French prices, in turn making domestic goods less competitive abroad and lowering exports, and making foreign goods more attractive and raising imports. The result is an inexorable deficit in the balance of payments, putting pressure upon French banks to supply gold to English, American, or Dutch exporters. In short, since in fractional reserve banking, paper and bank notes pyramid as a multiple of gold reserves, this expansion of the already engorged top of the inverted pyramid must inexorably be followed by a loss in the bottom, supporting the swollen liabilities. In addition, clients who are holders of French bank notes or deposits are apt to become increasingly concerned, lose confidence in the viability of the French banks, and hence call on those banks to redeem in gold, putting those banks at risk for a devastating bank run. The result will be an often panicky and sudden contraction of banknotes, generating a recession to replace the previous inflationary boom, and leading to a contraction in notes and deposits, a drop in the French money supply, and a consequent fall in domestic French prices. The balance of payments deficit is reversed, and gold flows back into French coffers. In short, the classical gold standard put a severe limit upon the inherent tendency of monopoly money issuers to issue money without check. As Ludwig von Mises pointed out, this international specie flow mechanism also described a correct, if primitive, model of the business cycle. While central banking and fractional reserve banking allowed play for a boom-bust cycle, the inflationary boom, and its compensating bust, was kept in strict bounds. While scarcely perfect or lacking problems, the classical gold standard worked well enough for the world, after World War I, to look back upon it with understandable nostalgia. Britain faces the post-war world. At the end of World War I, only the United States dollar remained on the old gold coin standard, at the 1/20th of an ounce par. The other powers suffered from national fiat currencies. Suddenly, their currencies were no longer units of weight of gold, but independent names, such as the pound, franc, mark, etc., their rates depreciating in relation to gold and volatile with respect to one another. Except for mavericks such as Cambridge's John Maynard Keynes, it was generally agreed that this system was intolerable, and that a way must be found to reconstruct a world monetary order, including restoration of a world money and medium of exchange. At the heart of the European monetary crisis was Great Britain, which would take the lead in trying to solve the problem. In the first place, London had been the major pre-war financial center, and second, Britain dominated the post-war League of Nations, and in particular, its powerful economic and financial committee. Furthermore, though inflated and depreciated, the British pound was still in far better shape than the other major currencies of Europe. Thus, while the pound sterling in February 1920 was depreciated by 35% compared to its 1914 gold par, the French franc was depreciated by 64%, the Belgian franc by 62%, the Italian lira by 71%, and the German mark in terrible shape by 96%. It was clear that Britain was in a position to guide the world to a new, post-war monetary order, and it eagerly took up what turned out to be the last remnants of its old imperial task. The British understandably decided that the fluctuating fiat money system inherited from the war was intolerable, and that it was vital to return to a sound international money, the gold standard. However, at the same time, they also decided that they would have to return to gold at the old pre-war par of $4.86. Apparently, few, if any, economists or statesmen at the time argued for cutting British losses, starting with the real world as it existed in the early 1920s, facing reality, and going back to gold at the realistic, depreciated $3.20 or $3.50 per pound sterling. In view of the enormous difficulties the decision to go back to gold at $4.86 entailed, it is difficult in hindsight to understand why there was so little support for going back at a realistic par, or why there was so much drive to go back at the old one. For going back to a pound 30 to 35% above the market rate meant that English exports, upon which the country depended to finance its imports, were now priced far above their competitive price in world markets. Coal, cotton textiles, iron and steel, and shipbuilding in particular, the bulk of the export industries that had generated pre-war prosperity, became permanently depressed in the 1920s, with accompanying heavy unemployment in those industries. In order to avoid export depression, Britain would have to have been willing to undergo a substantial monetary and price deflation to make its goods once more competitive in foreign markets. But, in contrast to pre-World War I days, British wage rates had been made rigid downward by powerful trade unionism, and particularly by a massive and extravagant system of national unemployment insurance. Rather than accept a rigorous deflationary policy, therefore, to accompany its return to gold, Britain insisted on just the opposite, a continuation of monetary inflation and a policy of low interest rates and cheap money. Thus, Great Britain, in the post-World War I world, committed itself to a monetary policy based on three rigidly firm but mutually self-contradictory axioms. 1. A return to gold. 2. Returning at a sharply overvalued pound of $4.86. And 3. Continuing a policy of inflation and cheap money. Given a program based on such grave inner self-contradiction, the British maneuvered on the world monetary scene with brilliant tactical shrewdness, but it was a policy that was doomed to end in disaster. Why did the British insist on returning to gold at the old, overvalued par? Partly it was a vain desire to recapture old glories, to bring back the days when London was the world's financial center. The British did not seem to realize fully that the United States had emerged from the war as the great creditor nation, and financially the strongest one, so that financial predominance was inexorably moving to New York or Washington. To recapture their financial predominance, the British believed that they would have to bring back the old, traditional $4.86. Undoubtedly, the British also remembered that after 2 decades of war against the French Revolution and Napoleon, the pound had quickly recovered from its depreciated state, and the British had been able to restore the pound at its pre-fiat money par. This restoration was made possible by the fact that the post-Napoleonic War pound returned quickly to its pre-war par because of a sharp monetary and price deflation that occurred in the inevitable post-war recession. The British, after World War I, apparently did not realize that A, the restoration of the pre-Napoleonic War par had required a substantial deflation, and B, their newly rigidified war structure could not easily afford or adapt to a deflationary policy. Instead, the British would insist on having their cake and eating it too, on enjoying the benefits of gold at a highly overvalued pound, while still continuing to inflate and luxuriate in cheap money. Another reason for returning at $4.86 was a desire by the powerful city of London, the financiers who held much of the public debt swollen during the war, to be repaid in pounds that would be worth their old, pre-war value in terms of gold and purchasing power. Since the British were now attempting to support more than twice as much money on top of approximately the same gold base as before the war, and the other European countries were suffering from even more inflated currencies, the British and other Europeans complained all during the 1920s of a gold, quote, shortage, or shortage of, quote, liquidity. These complaints reflected a failure to realize that, on the market, a, quote, shortage can only be the consequence of an artificially low price of a good. The, quote, gold shortage of the 20s reflected the artificially low, quote, price of gold. That is, the artificially overvalued rate at which pounds, and many other European currencies, returned to gold in the 1920s, and therefore the arbitrarily low rate at which gold was pegged in terms of those currencies. More particularly, since the pound was pegged at an overvalued rate compared to gold, Britain would tend to suffer in the 1920s from gold flowing out of the country. Or, put another way, the swollen and inflated pounds would, in the classic price-specie flow mechanism, tend to drive gold out of Britain to pay for a deficit in the balance of payments, an outflow that could put severe contractionary pressure upon the English banking system. But how could Britain, in the post-war world, cleave to these contradictory axioms and yet avoid a disastrous outflow of gold, followed by a banking collapse and monetary contraction? Return to gold at $4.86. The Cunliffe Committee and after. Britain's post-war course had already been set during the war. In January 1918, the British Treasury and the Ministry of Reconstruction established the Cunliffe Committee, the Committee on Currency and Foreign Exchanges after the war, headed by the Venerable Walter Lord Cunliffe, retiring Governor of the Bank of England. As early as its first interim report in the summer of 1918, and confirmed by its final report the following year, the Cunliffe Committee called in no uncertain terms for return to the gold standard at the pre-war par. No alternatives were considered. This course was confirmed by the Vassar-Smith Committee on Financial Facilities in 1918, which was composed largely of representatives of industry and commerce, and which endorsed the Cunliffe recommendations. A minority of bankers, including Sir Brian Cockayne and incoming Bank of England Governor Montague Norman, argued for an immediate return to gold at the old par, but they were overruled by the majority, led by their economic advisor, the distinguished Cambridge economist and chosen successor to Alfred Marshall's professorial chair, Arthur Cecil Pigou. Pigou argued for postponement of the return, hoping to ease the transition by loans from abroad and, particularly, by inflation in the United States. The hope for U.S. inflation became a continuing theme during the 1920s, since inflated and depreciated Britain was in danger of losing gold to the United States, a loss which could be staved off, and the new 1920 system sustained, by inflation in the United States. After exchange controls and most other wartime controls were lifted at the end of 1919, Britain, not knowing precisely when to return to gold, passed the Gold and Silver Export Embargo Act in 1920 for a 5-year period, in effect continuing a fiat paper standard until the end of 1925, with an announced intention of returning to gold at that time. Britain was committed to doing something about gold in 1925. The United States and Great Britain both experienced a traditional immediate post-war boom, continuing the wartime inflation in 1919 and 1920, followed by a severe corrective recession and deflation in 1921. The English deflation did not suffice to correct the overvaluation of the pound, since the United States, now the strongest country on gold, had deflated as well. The fact that sterling began to appreciate to the old par during 1924 misled the British into thinking that the pound would not be overvalued at $4.86. Actually, the appreciation was the result of speculators betting on a nearly sure thing, the return to gold during 1925 of the pound at the old $4.86 par. A crucial point. While prices and wage rates rose together in England during the wartime and post-war inflationary boom, they scarcely fell together. When commodity prices fell sharply in England in 1920 and 1921, wages fell much less, remaining high above pre-war levels. This rise in real wage rates, bringing about high and chronic unemployment, reflected the severe downward wage rigidity in Britain after the war, caused by the spread of trade unionism and particularly by the massive new unemployment insurance program. The condition of the English economy, in particular the high rate of unemployment and depression of the export industries during the 1922 to 1924 recovery from the post-war recession, should have given the British pause. From 1851 to 1914, the unemployment rate in Great Britain had hovered consistently around 3%. During the boom of 1919 to 1920, it was 2.4%. Yet, during the post-war, quote, recovery, British unemployment ranged between 9 and 15%. It should have been clear that something was very wrong. It is no accident that the high unemployment was concentrated in the British export industries. Compared to the pre-war year of 1913, most of the domestic economy in Britain was in fairly good shape in 1924. Setting 1913 as equal to 100, real gross domestic product was 92 in 1924, consumer expenditure was 100, construction was 114, and gross fixed investment was a robust 132. But while real imports were 100 in 1924, real exports were in sickly shape at only 72. Or, in monetary terms, British imports were 111 in 1924, whereas British exports were only 80. In contrast, world exports were 107 as compared to 1913. The sickness of British exports may be seen in the fate of the traditional major export industries during the 1920s. Compared to 1913, iron and steel exports in 1924 were 77.5, cotton textile exports were 65, coal exports were 80, and shipbuilding exports a disastrous 35. Consequently, Britain was now in debt to such strong countries as the United States, while a creditor to such financially weak countries as France, Russia, and Italy. It should be clear that the export industries suffered particularly from depression because of the impact of the overvalued pound, and that, furthermore, the depression took the form of permanently high unemployment, even in the midst of a general recovery, because wage rates were kept rigidly downward by trade unions, and especially by the massive system of unemployment insurance. There were several anomalies and paradoxes in the conflicts and discussions over the Cunliffe Committee recommendations from 1918 until the actual return to gold in 1925. The critics of the committee were generally discredited for being ardent inflationists as well as opponents of the old par. These forces included J.M. Keynes, the Federation of British Industries, the powerful Trade Association, and Sir Reginald McKenna, a wartime Chancellor of the Exchequer, and after the war, head of the huge Midland Bank. And yet, most of these inflationists and anti-deflationists, with the exception of Keynes and of W. Peter Rylands, Federation of British Industries president in 1921, were willing to go along with return at the pre-war par. This put the critics of deflation and proponents of cheap money in the curiously anomalous position of being willing to accept return to an overvalued pound, while combating the logic of that pound, namely deflation, in order to attain English exports competitive in world markets. Thus, McKenna, who positively desired a policy of domestic inflation and cheap money, and cared little for exchange rate stability or gold, was willing to go along with the return to gold at $4.86. The Federation of British Industries, which recognized the increasing rigidity of wage costs, was fearful of deflation, and its 1921 president Peter Rylands argued forcefully that stability of exchange, quote, is of far greater importance than the reestablishment of any pre-war ratio, end quote, and went so far as to advocate a return at the far more sensible rate of $4 to the pound. Quote, we have got accustomed to a relationship of about $4 to the pound, and I feel that the interests of the manufacturers would be best served if it could by some means be fixed at $4 to the pound and remain there for all time, end quote. But apart from Rylands, the other anti-deflationists were willing to go along with the pre-war par. Why? The influential journal, the Round Table, one of their number, noted the anomaly. Quote, while there is a very large body of opinion which wants to see the pound sterling again at par with gold, there are very few, so far as we know, who publicly advocates, in order to secure such a result, an actively deflationary policy at this particular moment, leading to a further fall in prices. End quote. There are several solutions to this puzzle, all centering around the view that deflationary adjustments from a return to the pre-war par would be insignificant. In the first place, there was a confident expectation, echoing the original view of Pigou, that price inflation in the United States would set things right and validate the $4.86 a pound. This was the argument used on behalf of $4.86 by the Round Table, by McKenna, and by his fellow dissident banker, F.C. Goodenough, chairman of Barclays Bank. A second reason we have already alluded to, the inevitable rise in sterling to par as the return date approached, misled many people into believing that the market action was justifying the choice of rate. But a third reason for optimism particularly needs exploring, that the British were subtly but crucially changing the rules of the game, and returning to a very different and far weaker, quote, gold standard than had existed before the war. When the British government made its final decision to return to gold at $4.86 in the spring of 1925, Colonel F.V. Willey, head of the Federation of British Industries, was one of the few to register a perceptive warning note. Quote, the announcement made today will rapidly bring the pound to parity with the dollar and will increase the present difficulties of our export trade, which is already suffering from a greater rise in the value of the pound than is justified by the relative level of sterling and gold prices. End quote. The way was paved for the final decision to return to gold by the Committee on Currency and Bank of England note issues, appointed by Chancellor of the Exchequer Philip Snowden on May 5, 1924, at the suggestion of influential British Treasury official Sir Otto Niemeyer. The committee, known as the Chamberlain-Bradbury Committee, was co-chaired by former Chancellor Sir Austen Chamberlain and by Sir John Bradbury, a former member of the old Cunliffe Committee. Also on the new committee were Niemeyer and Professor Pigou of the Cunliffe Group. We have a full account of the testimony before the Chamberlain-Bradbury Committee and of the arguments used to induce Chancellor of the Exchequer Churchill to go back to gold the following year. It is clear from those accounts that the dominant theme was that deflation and export depression could be avoided because of expected rising prices in the United States, which would restore the British export position and avoid an outflow of gold from Britain to the United States. Thus, Sir Charles Addis, a member of the old Cunliffe Committee, a director of the Bank of England, and the director upon whom Bank Governor Montague Norman relied most for advice, called for a return to gold during 1925. Addis welcomed any deflation as a necessary sacrifice in order to restore London as the world's financial center, but he expected a rise in prices in the United States. After listening to a great deal of testimony, the committee leaned toward recommending not a return to gold, but waiting until 1925 so as to allow American prices to rise. Bradbury wrote to Gaspard Ferrer, a director of Barclays and a member of the Cunliffe Committee, that waiting a bit would be preferred. Quote, "Odds are that within the comparatively near future, America will allow gold to depreciate to the value of sterling." End quote. In early September 1924, Pigou stepped in again, reworking an early draft by the committee secretary to make his economist's report. Pigou once more asserted that an increase in U.S. prices was likely, thereby easing the path toward restoration of gold at $4.86 with little needed deflation. Acting on Pigou's recommendation, the Chamberlain-Bradbury Committee, in its draft report in October, urged a return to $4.86 at the end of 1925, expecting that the alleged gap of 10 to 12% in American and British price levels would be made up in the interim by a rise in American prices. Even influential Treasury official Ralph Hawtrey, a friend and fellow Cambridge apostle of Keynes, an equally ardent inflationist and critic of gold, and chief architect of the European gold exchange standard of the 1920s, favored a return to gold at $4.86 in 1925. He differed in this conclusion from Keynes because he confidently expected a rise in American prices to bear the brunt of the adjustment. The British Labour government fell in early October 1924, and the general election in late October swept a conservative government into power. After carefully listening to Keynes, McKenna, and other critics, and after holding a now famous dinner party of the major advocates on March 17th, the new Chancellor of the Exchequer, Winston Churchill, made the final decision to go back to gold on March 20th, announcing and passing a Gold Standard Act, returning to gold at $4.86 on April 28th, and putting the new gold standard into effect immediately. It cannot be stressed too strongly that the British decision to return to gold at $4.86 was not made in ignorance of deflationary problems or export depression, but rather in the strong and confident expectation of imminent American inflation. This dominant expectation was clear from the assurances of Sir John Bradbury to Churchill, from the anticipation of even such cautious men as Sir Otto Niemeyer and Montague Norman, from the optimism of Ralph Hawtrey, and above all in the official Treasury memorandum attached to the Gold Standard Act of 1925. American support for the return to gold at $4.86. The Morgan Connection. Why were the British so confident that American prices would rise sufficiently to support their return to gold at the overinflated $4.86? Because of the power of the new United States Central Bank, the Federal Reserve System, installed in 1914, and because of the close and friendly relationship between the British government, its Bank of England, and the Federal Reserve. The Fed, they were sure, would do what was necessary to help Britain reconstruct the world monetary order. To understand these expectations, we must explore the Federal Reserve Bank of England connection, and particularly the crucial tie that bound them together, their mutual relationship with the House of Morgan. The powerful J.P. Morgan and Company took the lead in planning, drafting the legislation, and mobilizing the agitation for the Federal Reserve System that brought the dubious benefits of central banking to the United States in 1914. The purpose of the Federal Reserve was to cartelize the nation's banking system and to enable the banks to inflate together, centralizing and economizing reserves, with the Federal Reserve as, quote, lender of last resort. The Federal Reserve's new monopoly of note issue took the de facto place of gold as the nation's currency. Not only were the majority of Federal Reserve Board directors in the Morgan orbit, but the man who was able to become the virtually absolute ruler of the Fed from its inception to his death in 1928, Benjamin Strong, was a man who had spent his entire working life as a leading Morgan banker. Benjamin Strong was a protege of the most powerful of the partners of the House of Morgan, after Morgan himself, Henry, Harry Pomeroy Davison. Strong was also a neighbor and close friend of Davison and of two other top Morgan partners in the then-wealthy New York suburb of Englewood, New Jersey, Dwight Morrow and Thomas W. Lamont. In 1904, Davison offered Strong the post of secretary of the new Morgan-created Bankers Trust Company, designed to compete in the burgeoning trust business. So close were Davison and Strong that, when Strong's wife committed suicide after childbirth, Davison took the 3 surviving Strong children into his home. Strong later married the daughter of the president of Bankers Trust, and rose quickly to the posts of vice president and finally president. So highly trusted was Strong in the Morgan circle that he was brought in to be J. Pierpont Morgan's personal auditor during the Panic of 1907. When Strong was offered the crucial post of governor of the New York Fed in the new Federal Reserve System, Strong, at first reluctant, was convinced by Davison that he could run the Fed as, a real central bank, run from New York, end quote. The House of Morgan had always enjoyed strong connections with England. The original Morgan banker, J. Pierpont Morgan's father, Junius, had been a banker in England, and the Morgan's London branch, Morgan, Grenfell and Company, was headed by the powerful Edward C. Teddy Grenfell, later Lord St. Just. Grenfell's father and grandfather had both been directors of the Bank of England, as well as members of Parliament, and Grenfell himself had become a director of the Bank of England in 1904. Assisting Grenfell as leading partner at Morgan Grenfell was Teddy's cousin, Vivian Hughes Smith, later Lord Bicester, a personal friend of J.P. Morgan Jr.'s. Not only was Smith's father a governor of the Bank of England, but he came from the so-called, City Smiths, the most prolific banking family in English history. The establishment of the new gold standard of the 1920s. Bullion, not coin. One of the reasons the British were optimistic that they could succeed in their basic maneuver in the 1920s is that they were not really going back to the gold standard at all. They were attempting to clothe themselves in the prestige of gold while trying to avoid its anti-inflationary discipline. They went back, not to the classical gold standard, but to a Bowdlerized and essentially sham version of that venerable standard. In the first place, under the gold standard, the nominal currency, whether issued by government or bank, was redeemable in gold coin at the defined weight. The fact that people were able to redeem in and use gold for their daily transactions kept a strict check on the overissue of paper. But in the new gold standard, British pounds would not be redeemable in gold coin at all, only in, bullion, in the form of bars worth many thousands of pounds. Such a gold standard meant that gold could not be redeemed domestically at all. Bars could hardly circulate for daily transactions, so they could only be used by wealthy international traders. The decision of the British Cabinet on March 20th, 1925 to go back to gold was explicitly predicated on 3 conditions. First was the attainment of a $300 million credit line from the United States. Second was that the bank rate would not increase upon announcement of the decision, so that there would be no contractionary or anti-inflationary pressure exercised by the Bank of England. And third, and perhaps most important, was that the new standard would be gold bullion and not gold coin. The Chancellor of the Exchequer would persuade the large, clearing banks to, use every effort to discourage the use of gold for internal circulation in this country, end quote. The bankers were warned that if they could not provide satisfactory assurances that they would not redeem in gold coin, it would be necessary to introduce legislation on this point, end quote. The Treasury, in short, wanted to avoid, quote, psychologically unfortunate and controversial legislation, end quote, barring gold redemption within the country, but at the same time wanted to guard against the risk of, quote, internal drain, that is, redemption in the property to which they were entitled from foreign agents, the irresponsible public, or, quote, sound currency fanatics. The bankers, headed by Reginald McKenna, were of course delighted not to have to redeem in gold, but wanted legislation to formalize this desired condition. Finally, the government and the bankers agreed happily on the following. The bankers would not hold gold, or acquire gold coins or bullion for themselves, or for any customers residing in the United Kingdom. The Treasury, for its part, redrafted its banking report to allow for legislation to prevent any internal redemption if necessary, and, quote, enforce such a ban on the all-too-willing bankers. Under the Gold Standard Act of 1925, then, pounds were convertible into gold, not in coin, but in bars of no less than 400 gold ounces, that is, $1,947. The new gold standard was not even a full gold bullion standard, since there was to be no redemption at all in gold to British residents. Gold bullion was only due to pound holders outside Great Britain. Britain was now only on a, quote, international gold bullion standard. The purpose of redemption in gold bullion only, and only to foreigners, was to take control of the money supply away from the public, and place it in the hands of the governments and central bankers, permitting them to pyramid monetary inflation upon gold centralized in their hands. Thus, Norman, when asked by the governor of the Bank of Norway for his advice about returning to gold, urged Norway to return only in gold bars and only for international payments. Norman's reasoning is revealing. Quote, in Norway, the convenience of paper currency is appreciated, and confidence in the value of money does not depend upon the existence of gold coin. Demand is rendered more inelastic wherever the principle of gold circulation, for currency or for hoarding, is accepted, and any inelasticity may be dangerous. I do not believe that gold in circulation can safely be regarded as a reserve that can be made available in case of need, and I think that even in times of abundance, hoarding is bad, because it weakens the command of the central bank over the monetary circulation and hence over the purchasing power of the monetary unit. For these reasons, I suggest that your best course would be to establish convertibility of notes into gold bars only, and in amounts which will ensure that the use of monetary gold can be limited, in case of need, to the settlement of international balances. End quote. Norway, and indeed all the countries returning to gold, heeded Norman's advice. The way was paved for this development by the fact that, during World War I, the European countries had systematically taken gold coins out of circulation and replaced them with paper notes and deposits. During the 1920s, virtually the only country still on the classical gold coin standard was the United States. Despite this tradition, it was still necessary for Monty Norman and the Bank of England to exert considerable pressure to force many European nations to return to gold bullion rather than gold coin. Thus, Dr. William Adams Brown, Jr. writes, quote, in some countries, the reluctance to adopt the gold bullion standard was so great that some outside pressure was needed to overcome it. That is, strong representations on the part of the Bank of England that such action would be a contribution to the general success of the stabilization efforts as a whole. Without the informal pressure, several efforts to return in one step to the full gold standard would undoubtedly have been made. End quote.